Hi, George. Hi there.
Morning, Michael. How are you?
Hey, nice to see you. Good morning.
Good morning.
Um, okay, and I've got an interesting one today. I'm trying my best to kind of provide on this one some of the kind of things that I'm trying to do when I buy into a company, when I structure the portfolio, and when I come to sell the position. I'll just give it another minute or so to see if anyone else shows up. I know a couple of people were on holiday. How are you doing? You okay?
Oh, I'm fine, thank you.
Yeah. Are you retired?
I am retired. I'm retired military.
All right.
Um, yeah, and I have one property that I own, manage that, and so it's kind of simple life. And I did get a little bit of a good inheritance, but with bad investing, it's I've managed to diminish it. Uh, and but anyways, you're helping,
Yeah.
so I'm very
Do, do, do
grateful.
you do you read a lot about I know that there's a lot of stuff out there, but do you read a lot about investing, like books per se?
Um, I read Kramer's one of his books about what was that? Just go little by little. You know, um, so I've listened to Seeking Alpha. I've listened to some friends. I've listened to Kramer a little bit, and that hasn't helped so much. But and then my own thinking, like shipping stocks. I lost a bunch in shipping, but I think that's completely beaten down crazy. So, for example, Zim was a $60 stock and it's around 11 now, and their NAV is still high. I mean, the stock is like the half of what an NAV is, but they're expecting it to just two, I guess, could go to zero practically. But I definitely bought too high on that.
So, you know, it's important when investing, and it's difficult, and I recognize it is really difficult, but it's important when investing to have more moderate expectations and not go for things that can just shoot up, because
Yeah.
even in those cases where things shoot up, I don't know if you're very familiar with a bell curve. Bell curve is just like the shape of a bell.
Hmm.
Um, and what happens is the bell is the average. So the vast majority, let's say approximately 70% of the returns are in this kind of the majority of the bell shape. And then you got the right part of the bell curve. And the right part of the bell curve is where people get the extraordinary returns. Now, the problem with investing in certain high risk businesses is that when it does work out, you for not you, but one has been seen that stock go down, go down, go down, and you kind of got it at the bottom. Pretend, just for the sake of our discussion, you got it at the bottom, and it's like 2 months later, you're holding 30 or 40% return. You're like, oh my God, yeah, 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 well, sell, I'm done. The problem is you're cutting off the right part of the curve. You're cutting off where you really get that kind of juice coming out.
Hmm.
And those high return strategies are so infrequent, it's so irregular. Over the last 2 weeks, we've been discussing here, and it's really a rare instance where something goes from hero to zero back to hero. Okay, those are really rare instances. So I believe a slightly better strategy is to not get so involved with those types of stocks that can go to the moon. Now, if you want to, if that's a person's predisposition to, you kind of want to do that, like put 5% of your portfolio in that, and you will find that it kind of itches that feeling in you, but the 5% is not 5% into one stock, it's 5% into, let's say, 10 stocks that are like that. So I think that, because what we discussed last week about, when so-and-so was saying that in 2002, Apple was a net, it was like the cheap stock, like really, really cheap. But a person's ability to hold on to that, you kind of, you're going to cut it off, you're going to cut it off. So I think that having different types of businesses in the portfolio are really helpful. And I discussed that last week, but I'll just repeat that again, because there's different types of sensitivities to interest rates. So I'm just, for example, writing up about MoneyLion. MoneyLion is a business that's very much contingent on a change in the interest rates. If interest rates kind of come down a bit, this business will flourish. But let's be realistic, not every business is going to do, you can't have a portfolio where it's all contingent on the Fed lowering interest rates. The reason the Fed, I'm not a macro investor, but the reason why the Fed lowers interest rates is because the economy is weak, right? You're not lowering it, it's because it's weak. It's kind of, that's it. So it's important to have different types. That's why I'm not just like trumpeting my book, but I have kind of some dividend stocks, and these are boring, man. I get it. Like I'm a motivated person, and I also want to kind of get involved those kind of jazzy things. But there's that George Soros quote that I mentioned last time, which was, if you're investing and you're having fun, then you're losing money. Real investing is really boring.
Right.
I take this to heart. This is someone that is like, if you know George Soros, he has quite a personality. And this is someone that's kind of, done and dusted. And he says, okay, I can see the path. And the path to really making money is not like where you kind of trying to go for pleasure in the market. It's really boring. And just to kind of finalize that bit up, I think that, having some large caps, having some small caps, having different things, and where you're not having to make a decision every week. Okay, shall I sell now? The market is up, the market is down. What shall I do? You don't want to be in that position where you're looking towards the market. What shall I do? You want to have a framework of things that you can control, and this is kind of what I'm kind of gonna talk about today. So kind of use this as a segue to kind of just jump right in here. So I wanted to today, making some notes for myself, that I wanted to kind of talk about the strategy for buying into the portfolio. And the way that I say these kind of talks is, a person can take whatever they want from them. And if they, for example, feel that, okay, this works for me, take it. And if it doesn't work for you, that's fine. I'm just trying to provide some experience that I've seen a lot of things happen over time, and I've written about them. And it's kind of built up a catalog of experience. And I think that, this experience is quite valuable, because if you've been if you've been in the trenches a little bit, and you're kind of, you've been in the ups and you've been in the downs, and you've been like really in the trenches, and you've seen how things are, and you read people's comments, because those comments of people on the articles that I read, I like to go over my own stuff that I've written in the past 6 months, or in the past 2 quarters, 3 quarters, and see what were people feeling, what was the reaction of people at the time. And it's a great business lesson to see people's emotions at that moment in time. And that's why I always say, there are things that you can control, and there are things that you cannot control in the market. Okay, you can't control what the share price is going to be, but you can control the framework that you put into this path. So as I said, like I was telling you, George, at the start, that for me, the most important thing here is, when I'm thinking about the business, I want there to be a business where I can be the owner of that business, and I can stay with the business. So you gave the example at the start about shipping stocks, but it can be anything, right? You don't want it to be that the time is running against you and you see that the share price is going down, 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 and you're forced to act, okay? Because that you're prohibiting yourself, you're working against yourself. So what I personally do is before I start anything, I just kind of, before we do anything, I just look at the balance sheet, and you and I already discussed this last week. Just look at the balance sheet. It takes like 5 minutes, not even that, like couple of minutes, and it's like it cuts, like it's just like, okay, it just cuts for so much noise. I was writing this morning about a little hyped up AI stock, BigBear.ai, even has AI in the name, and I was looking through what I'd written at the height, at the peak of the AI bubble, like a couple of months ago. And, I was also, I was reading and I was seeing everything was going to the moon. And, it's kind of like, well, like what's happening? And I wrote at the time, okay, this is what the balance sheet looks like. And I recognize that the share price is going up as I write this. I recognize this very much. But I believe that, in 3 or 6 months' time, common minds will prevail. And but by just looking at I was never going to invest in that business, but just by looking at the balance sheet, I was like, okay, there's a little bit of cash here, and there's like quite a large stack of debt. And you don't need to be like an accountant. You don't need to kind of go into the annual reports and kind of dig out, oh, when is this due? What are the covenants? You don't need to do any of that. You just say, okay, like there's a little bit of cash, there's a lot of debt. Okay, it's simple. I don't need to kind of reinvent the wheel, and you can just move on, right? And even if a person hasn't got a lot of time to look for this kind of stuff with the balance sheet and everything, it's a couple of minutes, man. It's a couple of minutes, just cuts through a lot of noise. And I'm not trumpeting my horn. I'm just giving this like as an example. I kind of spoke like I can't remember now, 2 or 3, maybe 4 weeks ago. I talked about BlackBerry as well. So like it just helps a little bit kind of put this box around the business and kind of, okay, is the business in a steady footing? Because even if the business is going to do quite well, like Big Bear or BlackBerry or whatever, just kind of make it like, just make it for yourself easy so that you can stay with the business. And I think that's kind of something that's like the number one thing that I think is really important. The other thing, and this starts to become a little bit more challenging, but the way that I'm trying to explain this is I'm trying to do it in a way that is reproducible for you. Okay, so you kind of go through and you can reproduce this strategy without you don't need to be a genius, you don't need to be Warren Buffett. You just like, these are like just some small principles. They don't take many minutes, but once you kind of got into this motion, it's kind of like, okay, yeah, I got to do this, I got to do that, I got to do that. It's like, so there's 3 things. So you look at the balance sheet. The second thing is you just spend a couple of minutes thinking hypothetically, what can the business's free cash flow be next year? Now, don't be put off by the word free cash flow. It just means basically the real cash, not earnings, because earnings is just a person's estimate of what the business could be making right now, because it's an estimate. You don't know how much you're going to depreciate the service. You don't know how much stock-based compensation you're going to give to your management team. It's just an estimate that the earnings figure. But the cash is the cash, right? The cash is what it is. There's no kind of, it's not difficult. You look at the cash flow after they've invested in their capital expenditure. So it's just a free cash flow. It's not it's just what it's called, just the cash of the business. And in my daughter, sometimes she like be at home and she'll say, oh, like, how long would it take for someone to fly to
let's look at the
and we just kind of say, and we just kind of and I just kind of say to her, I don't know, how long do you think, right? And she's like, I don't know. I don't know is not an answer. Just kind of like give an answer, any answer. It doesn't matter. Just like, but by forcing you to think about what the business's free cash flow can be next year, it just kind of helps a little bit for you to have this kind of understanding. Is the business going to make more free cash flow next year, or is it going to make less? Okay, just start from there. If they've had a really strong period right now, man, like they may not have such a strong period next time. Okay. And the other thing that I would just say is that I think that it's quite important to think about not investing in businesses that are shrinking. Okay, so like businesses that are going through a period where they're shrinking, smaller revenues, smaller earnings. Just I would try and avoid that, because what you're trying to do is you're trying to invest in a business that can next year be stronger. Okay, because if the business is strong, it doesn't need to grow a lot. Like it doesn't need to grow much, really. 5-8%, that's kind of, as long as the multiple that people are paying on that business remains relatively stable, then that means your stock would go up, let's say 5 or 8%. And that's, it's not exciting, it's not amazing, but thinking like that, it just kind of rebalances a person's expectations and stops someone from getting overwhelmed. Oh, the business I thought is going to do really well. It's like just cuts off that. So thinking about what can the business make next year. I believe that it's important not to think about more than 1 year out, because there's Philip Tellock and others have shown that people have a complete inability to forecast over time, like more than a year out. Even the best of the best. I don't know if anyone's kind of read this Philip Tillich book, but it kind of shows that it's called super forecasting. It just shows that even people that's their passion. They kind of go in these tournaments and try and forecast, and they try and have an idea what things can be next year. After 12 months, it was just throwing a dice. It was just rolling a dice. Nobody can really forecast a very long period into the future. But how do you get around that, right? What is the way to get around something where you need to make an estimate of the future, but you acknowledge that it's quite difficult to forecast? So how do you get around that? And the way that I believe makes sense is invest in businesses that are stable, right? If the business is up a lot, down a lot, up a lot, down a lot, no one knows what the business is going to make, right? If it's so susceptible to the overall macro environment, it's difficult. And I've been guilty in the past. I've kind of looked at something and said, "Oh, this business is so cheap. It's priced at, let's say, 6 times or 9 times earnings. Oh, it's like so cheap." But if I just been a bit more strict to myself and I've gone past and looked at the previous 3 years, you don't need to look back 30 years. Just look back the previous 3 years, and you see there's a lot of volatility between each year. You say, "Oh, something odd is happening," because it's not normal for a business to grow. Because it's quite difficult. If you think about to grow a business at 50%, or if that means like in less than 2 years, it's doubled. So you need to hire twice as many people. You need twice as many servers. You need twice as many desks. And then the year after, you need like 4 times as many, right? So it's really thinking in those ways that it's quite irregular. There's no business, like even Microsoft or whatever, that is growing for a prolonged period of time at 30%. No business. Like you can get 5 years, you can get like some business you may squeeze out of 7 years, but it's capitalism, right? So it's just common sense that try and pick out businesses that are stable, businesses that have a solid balance sheet, and try and pick out businesses that, looks like at least that they're going to become more profitable next year. Okay. The other thing that I think is quite important is to not necessarily buy into stocks all the time. For example, because there are periods of time when the market looks really, really cheap. Okay, so everyone says, "Oh, buy the dip," right? And everyone looks back to COVID period, April period, when that was a tremendous time to buy the dip. But that period was so abnormal that it only lasted like 2 months. So it kind of came down, it just soared back up, and everyone looked like a genius that had bought in. But normal market sell-offs, they don't last 2 months. They don't even last 6 months. They can last like a year, 2 years, approximately. So going through those periods where you are the market sells off and you are putting capital to the work, I recommend space it out. Just, even if like something looks, like it's the next Nvidia, doesn't matter, just space it out, because the longer that you've been the owner of a stock or a business, the longer you've been a business owner, the more familiar you are with the business. You kind of have a grasp for it. I play a lot of chess. I'm not a very good chess player, but I play a lot of chess, and I just, you're kind of in the back of your mind, you're thinking about a move. Like, you're like, oh, you're thinking about a move. And the same when you're buying a share of a business, you're kind of like, okay, just for example, like if you buy a share of Apple or whatever, you're like, okay, like you're thinking about the services of Apple. You kind of just, I was like, I don't own Apple, but I'm just thinking to myself, I went for my jog today, and I was looking at my phone, I was like, man, if this phone went, it would take all my photos that I have of my family. Those are my memories. And I was like, I would pay a lot to have those memories, to hold on to those memories if something were to happen to the phone. So you kind of thinking about the services part of the business. It's just an example. I mentioned Apple just because it's a well-known business, but you can think about this other thing, whatever it be. Like if someone is on Azure and it's like, oh, this cloud service is amazing, whatever. And I'll just caveat this briefly. And I think that a lot of investors, particularly this up and coming generation right now, is they fall in love with the productivity tools that they use. So people that are kind of come from the developing background, they're like, oh, I know this business. And just because they know the business doesn't necessarily mean that it's a good business to invest in. And people say, oh, it's the Peter Lynch thesis, where invest in the things you know. And the comeback that I counted out, okay, yeah, Peter Lynch, terrific, but he had a team of people. That's the first thing, working for him. Team, like a whole floor of people. Secondly, those types of businesses that were around in the 80s were pretty much a mall or retailer. So what works in one retail setting is quite likely to work in a different retail setting, like in a different mall. Like you have Walmart works here, it's going to work somewhere else. It's kind of there's a predisposition for it to work in elsewhere, but it's not always the case. Like the classic example is Buffett's See's Candy, that it's like Americans will know this, that it's basically like a sweet. They've tried to expand it across the US, but it hasn't worked very well. So it's not always the case. But what Peter Lynch was doing is really this, like, invest in the things that you own, that but you have to take in the context that those business models were slightly simpler and people weren't paying heroic valuations for those kind of things. So it's important, I believe, to have some, not a lot, but have a little bit of an analytical thinking about the things that a person is kind of investing in. The other thing that someone wrote to me at the weekend, and I think it's quite important, is when it comes to investing, I strongly recommend that a person writes down a checklist. So in the checklist, it can be, simple things. For example, we talked about the balance sheet, we talked about the free cash flows of the business, but having this checklist is really, really helpful, because I recommend strongly a person writes 3 things to explain why they're buying into the business, okay? And I'm going to give a practical example of how I did this for one of my stocks recently, okay? So you write down like your 3 things of why you kind of want to buy into this business. And I personally recommend that those 3 things are not necessarily talking about the valuation. So just because something is cheap relative to the peers in the group doesn't necessarily mean that it's undervalued. It could be, but it doesn't necessarily mean. I believe very much that on the other side of the trade, or whenever if I'm buying into something, someone's selling, right? So I believe, generally speaking, over a longer than 6 month period, the market is kind of right in things. It might nudge a little bit, might have a bit of a sell-off here, or a bit of the shares go up in a different day. But for the large extent, I believe the market is kind of reasonable. And I have in the past been guilty of saying, oh, Tesla is overvalued. And I've been saying that since like 2014. So like, people say whatever they want. And for a long period of time, it doesn't make sense until, yeah, that is the price. It's like one of the best businesses in the world. And yes, so I believe the market is generally right. Doesn't mean that it's always right, but it's kind of generally right. But I think that write down 3 bullet points of why you're buying into a certain thing. And this is really the real nugget here. Before you sell the stock, read what you wrote, the why of you bought the business in the first place. So I can't remember now, was it 4 or 5 weeks ago, I said I was going to sell a portion of Builders First Source. This is a stock that done quite reasonably well for me. And when I kind of was going to do it, I was going to I want to sell this business. It kind of done well for me. I was like, yeah, kind of tap myself on the back and this and that. But I went through and I went on my most kind of recent analysis, and I just read, like, why was I so bullish about this? And I went through it. I was like, you know what? Like, I think that there's still a bit more wiggle room here. I think that there's still more upside. But because I went and read what I've written, I was able to say, okay, I was able to check against myself. So this checklist is for you as a person, because when you bought into a stock, you kind of write, and it doesn't, all my techniques that I'm saying are things that should be extremely practical. And, we live in a fast world, has to be something that's fast. You can just write like 3 bullet points, like takes a couple of minutes. But those 3 bullet points that take 5 minutes, together with, let's say, 5 minutes of looking at the balance sheet, like 10 minutes altogether, it can really save quite a lot of capital and a lot of removing a lot of the emotional bias from investing. So yeah, that's my little spiel for today. If anyone wants to kind of ask, I am mute. So I'm sorry, I muted somebody here before. I think it was Prince. I think I muted you before. Can you unmute yourself? Don't know. Okay. Don't know. Would anyone like to ask any questions?
I'll ask since it's a little empty time there. Um, you mentioned about buying into the dips, and you mentioned about steady investing, right? And not just trying to jump all in once. But yet, explain a little bit about, well, when something's are down, like for example, HIMSS is right down now. Wouldn't it be a good time to put a little extra in that?
Mm-hmm. You always ask really good questions, and I like your questions. And I'm not just saying that because you asked them, but you asked really good questions, and they really make me think a lot. And what I have this kind of, I come up with this framework, and it's not a perfect framework, but just to space things out, so you can kind of put a little bit more, give it 4 to 6 weeks. So the way that I personally do it is I put, let's say, a third in, and then like 4 to 6 weeks later, put another third, and then 4 to 6 weeks later. By that point, I've passed over a quarterly period, and I've got a bit more of a sense, right? Because I've been a business owner. I've thought about it from being a business owner's perspective for at least 3 months, and I kind of got a feel for it. Typically, I hold on to a stock for about 18 months. So it's either working or it's not. So a year and a half, you kind of know. Now, HIMSS come down quite a lot. It's it hasn't performed very well. I'm quite confident that I know why it's not working. People don't like that they have so much investment into SG&A. Their marketing expense is really, really high, and the people believe, rightly or wrongly, that that the business hasn't got a path to be substantially profitable. I would counter that by saying, if a business is growing at more than 30%, they should be doing everything they can to continue to grow. Now, I know that line of thinking presently is out of favor, but that's really. But in the case of him, it's growing substantially faster than 30%, even substantially faster than 40%. So why in the world should they really curtail their opportunity and let some other competitor come in? The second thing I would say, and I'm not just saying that because I own Hims, but ever since these guys did the SPAC, they had a little investor presentation, and I think it was 2020 or something like that. Ever since then, they had the guidance, and they've consistently met and over-delivered against that guidance. So, yeah, people talk a lot when they're doing their SPACs and IPOs and whatever. People talk a lot, but ultimately, all they've done is just put some numbers into a spreadsheet and say, I think this is what the business is going to do. But these people have actually delivered against that. So I'm very mechanical about my buying and selling, and if something is not working, I'm quite mechanical about that. But a bit of common sense here, like these people are really delivering, and I'm not just saying that, but I'm quite excited to see what the next year is going to hold for this business, because they're really astounding me. And being a small cap, that's the whole appeal of investing in small caps, is that if something is working out well, it can really just easily double. It can quite easily double in a quarter. I've seen this happen many times. So yeah, I don't think that that I want to punish this business, but I do think it's important to space it out a little bit, like buying into a business.
Thank you.
Does anyone else want to ask any other questions?
Hi, this is Pen. Can you hear me, Michael?
I can hear you very nicely. How are you doing?
Hi, I'm well. Sorry, my camera's not working
That's
again.
fine. I don't
But
mind.
thanks for doing this. I'm
Thank you.
just wondering, Michael, where do you get, your ideas from? Like, do you have a systematic way of screening?
So
Or
I get this question quite frequently, and I don't. I don't have a systematic way, and a lot of people use screeners. But I look at so many stocks, and so many people write to me all the time, that I don't have to do anything nowadays. That's one of the, I'm not just touting my horn here, but I was quite lucky that I've got a reasonably large following, that people just write to me consistently with like, oh, I own this stock. What do you think of this? So nowadays I don't have to. My only job nowadays is, and I'm not trying to be cute or something, but my only job nowadays is to say no. I just say no to 99% of ideas. And I know it sounds kind of like I'm saying, I'm trying to kind of sound better than I am, but that's the screener. I just ask everyone else to do the work, and yeah, it comes up.
so you're saying through your own network and among the
Yeah,
subscribers and so on.
yeah,
Is that
that's
right?
it. Yeah.
Okay. Okay. Thank you.
Okay. Don't think there's any other questions today. Do you have a question, Prince? Oh, George, do you have another question?
I'll just UEC. I would think that's a good time to keep investing. Do you have any update on UEC?
Yeah. So I think that George, from what we discussed at the start, space it out. Okay, that's the first thing. No stock, no matter how good, goes up in a straight line or down in a straight line. Okay, so it's up significantly in the last. It can just as easily come back down. Don't rush.
Okay.
Okay, that's the first thing.
Okay.
I strongly believe that the thesis hasn't even started to work, because the business. I said from the start that for UEC to start the thesis to work, the price of uranium needs to be above 60 for at least 3 months. It's only 2 weeks. So we need at least 3 months, and for the price to stay kind of at this price, for them to start, like to get into the mines and to start. So it like there's plenty of time. It's gonna take a bit of time. There are 2 businesses that I really don't want to just sell at, like, not at any price, but there are 2 businesses. UEC is one, Antero Resources is the other one, that I would just hold on until this whole energy transition has kind of started, because this has really fallen from everyone's radar. And I believe that, for example, there are kind of what they call like super commodity cycles. These kind of cycles can last, let's say, like 10 years or something. If you think about it, since approximately 2011, uranium has been dead. So it's like kind of 12 years that sector has been dead. So it's now with UEC, it's like it's 2 months that the share price is up, and we're not even started. Like, but that doesn't say like you keep buying every day, but you just kind of, you just try your best to space it out. Write a little note on a calendar, space it out. You kind of, you're buying into this, because any stock, it can go down like 20-30% in a week.
Thank you.
Okay, I think that's it for us today. Thank you so much, George. Thank you, Pearly. Thank you for the other people on the call as well.
Thank you.
Thank you so much, and I look to see you guys next week. Thank you.
Thank you, Michael.
Thank you so much. See you soon. Bye-bye.